Hey everyone, welcome back to Corporate Decoder. Today CVC-PE Global Private Equity Fund, LPCVC, just filed an 8K talking about unregistered sales of equity, and I'm seeing some interesting details about how they price their units. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing gives us a peek into how private funds price their offerings, and it reveals a key difference between how they calculate value versus what you might see on a public stock exchange. Alright, so we are looking at an 8K filing from CVC-PE Global Private Equity Fund. This is a fund, not a typical public company you'd invest in on the stock market that has common shares traded daily. Think of it more like a pool of money managed by professionals, set up as a limited partnership. They are telling us about some recent sales of their limited partnership units, which are kind of like shares in the fund itself. So on June 2021, this fund sold what they call unregistered limited partnership units because this is a private fund. These sales don't happen on a public stock exchange. They are part of something called a continuous private offering. In total, they raised about $10 from these sales. Now the interesting part here is that these units are unregistered, meaning they are not registered with the Securities and Exchange Commission, or SEC, in the same way a public company's stock is. This is allowed for private offerings under certain rules, like Section CRR and Regulation D of the Securities Act of 1999. This basically means they are selling to a limited number of sophisticated investors who are expected to understand the risk. Let's dig into the numbers. They sold different classes of units. First, there were Class RS units, where they sold 391,131 of them, and raised just over $42.3 million. Then we have Class RI units. They sold 120,221 of these, bringing in about $13 million. Finally, there is a very small number of Class C units. Only 455 were sold, for a modest $50,000. This specifically mentions these were purchased by CVC or people associated with CVC, like employees or officers. It is common for fund managers or employees to invest in their own funds. Now, here is a crucial detail. The exact number of units sold and the final price were actually locked in on the 25th of June 2026, but the price itself was based on what is called the Transactional Net Asset Value, or Transactional NAV, as of May 29, 2026. This means the selling price on the 1st of June was determined by the fund's value from a few weeks earlier. This is a bit different from how public stocks trade, where the price can change by the minute. And notice here, part of these sales went through something called a feeder fund. This is a common structure in private equity where investors first put money into a feeder fund, which then invests in the main private equity fund. This is often done for tax reasons or to accommodate different types of investors like United States tax, exempt investors, and foreign investors. As mentioned before, these sales are exempt from standard registration requirements because they are part of a private offering to a specific group of investors who are presumed to be knowledgeable enough to assess the risks involved. Now let's talk about this transactional net asset value, or NAV, because it is key to understanding how these units are priced. The fund uses this transactional NAV to set the price for buying and selling units. And as of May 29, 2026, here is what those prices look like per unit. For Class R units, the transactional NAV was $108.19. For Class RI units, it was $108.39. And for Class C units, which were purchased by insiders, the price was $109.9. Interestingly, there is also a Class G unit mentioned with a transactional NAV of $108.39. Though no sales of this class were reported in the table we just looked at. So what exactly goes into this transactional NAV? The fund explains that it is based on the month-end fair values of all their assets minus their liabilities, plus all fees and expenses that are part of the fund. This includes things like management fees, incentive allocations, and other operating costs. They have a whole valuation policy approved by their board of directors that guides this process. Here is a really important part that shows how the fund manager is supporting the fund's value. For a year starting the 1st of April 2026, the investment advisor, CVC Advisors Us Incorporated, has agreed to cap certain expenses. If these specified expenses go above a certain limit based on the fund's NAV, the investment advisor will cover the difference either by paying it directly or by waiving their management fee. This is known as expense support. It is basically the manager putting their own money where their mouth is to help ensure the fund's performance and value don't get eaten up by excessive costs. They also clarify how certain items affect the NAV. Expense support is accounted for when the fund effectively reimburses the advisor. Servicing fees directly reduce the NAV each month. And importantly, they might not factor in certain contingent tax liabilities if those taxes are unlikely to be paid due to how they plan to sell off investments. This is a nuanced point that shows how tax planning can influence the reported value. They are also upfront that this transactional NAV might be different from the net asset value calculated using standard US generally accepted accounting principles, or GAAP. This highlights that private funds can have their own specific ways of valuing things, which can lead to different numbers than what you might see for a publicly traded company. And the report is signed by Jonathan Wrigley, who is the Chief Financial Officer of CVC-PE Global Private Equity Fund, LP. This confirms the information is officially coming from the fund's leadership. Now, looking at this filing, what is the story here? It is really about the mechanics of private fund investing. They're selling units, raising money and using a specific internal valuation method, the transactional NAV, to set prices. The fact that the price is set based on a past date and that the manager is providing expense support tells us a lot about how these funds operate to attract and retain investors. It is a way to provide some stability and predictability in pricing, which is different from the daily fluctuations of the public markets. The biggest takeaway for me is understanding how private equity funds price their investments. They don't have a stock ticker flashing prices every second. Instead, they rely on periodic valuations. The transactional NAV is their way of putting a price on their units at a specific point in time, and it is influenced by the underlying performance of the fund's assets and how they account for fees and expenses. The expense support is a positive sign, showing commitment from the management to help smooth out the ride for investors, especially in the short term. One thing to consider is that this transactional NAV might not always perfectly reflect the immediate market value if the fund were suddenly forced to sell all its assets. But for an ongoing private offering, this method provides a consistent way to transact. The distinction between this and GAAP NAV is also worth noting. It means investors need to understand the specific valuation methodology being used. The risk I am watching for these types of funds is always liquidity. While these sales happen, the ability for an investor to get their money out on demand is usually very limited. They rely on specific redemption windows or the sale of the fund's assets to return capital. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded if this analysis was valuable. Hitting that like button really helps. And subscribe for more deep dives. Check out the Discord in the description.